Crosswinds, navigating AI investment in a volatile market. Welcome to AI Unveiled, hype versus reality.
Today we're diving into a critical relationship that's reshaping the AI landscape but isn't getting nearly enough attention: the connection between bond market volatility and the future of AI innovation.
The economic context.
What we're seeing across the industry is a fascinating economic narrative unfolding in real time. Last week's surge in interest rates has sent tremors through financial markets. The 10-year Treasury yield jumped from 4% to over 4.5%, a significant move that many AI innovators and investors have missed entirely. This interest rate volatility wasn't random. It was sparked by President Trump's recent tariff announcements, creating ripple effects that extend far beyond traditional finance.
The venture capital connection.
Let me break down why this matters tremendously for the AI ecosystem. Global venture capital hit $126.3 billion in Q1 2025. This marks its highest level in nearly 3 years. That's promising news on the surface, but it's directly connected to the Fed's interest rate cuts last year. Based on my 2 decades of experience analyzing these cycles, I've consistently observed a clear pattern. When interest rates climb, funding for innovative but unproven technologies typically contracts severely. Early-stage AI startups often feel this pinch first and hardest. The historical data tells an unambiguous story. Looking at the past decade, we can see how falling Treasury yields created the perfect environment for tech deal-making. When COVID hit and the Fed slashed rates, quarterly VC deal value exploded. It grew from $79 billion to an astonishing $211 billion in just 6 quarters.
Real-world implication.
So what does this mean for AI development specifically? Let me share a recent example. A client of mine, a promising generative AI startup developing creative content tools, just secured Series B funding last month. Their CEO told me something revealing. 3 months later, and we might have missed our window completely. In my discussions with executive leadership across multiple AI verticals, I'm hearing consistent concerns. Applied AI startups in healthcare and finance remain relatively insulated. Meanwhile, more experimental, deep tech, and foundational model companies face heightened vulnerability. The divergence of AI sectors. We're witnessing a fascinating divergence between different AI sectors. This mirrors what happened during previous contractions. When funding tightened in 2022, AI companies building practical, revenue-generating applications actually accelerated their growth. At the same time, moonshot projects stalled or failed entirely. Consider Anthropic as an example. Their strategic partnering with Amazon and innovative financing structures demonstrates one approach to navigating uncertain capital markets. Or look at enterprise AI platforms focusing on cost reduction in manufacturing and logistics. These companies are now being prioritized by investors seeking defensive plays in an uncertain economy.
Strategic responses.
For AI founders and executives listening, this economic reality demands 3 specific strategic pivots. First, extend your runway aggressively. The companies that survive downturns emerge dramatically stronger, often becoming category leaders in the recovery phase. Second, demonstrate tangible ROI faster. In my work with Fortune 100 companies implementing AI solutions, I've observed how economic uncertainty accelerates the demand for proven, measurable impact. Third, consider alternative financing structures. Revenue-based financing, strategic corporate partnerships, and government innovation grants often become more accessible during these periods.
The counterintuitive opportunity.
Yet within this challenging landscape lies enormous opportunity. Some of today's most transformative AI companies found their footing during funding contractions. Economic pressure forces technical innovation, business model clarity, and strategic focus. These pressures create the perfect conditions for truly revolutionary approaches. What separates winners from casualties isn't just technical excellence, but strategic adaptability. The next wave of paradigm-shifting AI companies will likely emerge from this very intersection of technological potential and economic constraint. The relationship between macroeconomic cycles and technological innovation reminds us that AI development doesn't happen in a vacuum. As we navigate these crosswinds, the most resilient innovators will balance ambitious technical visions with pragmatic market awareness. I'm Asif Waliuddin, and you've been listening to AI Unveiled, where we separate hype from reality If you found this analysis valuable, subscribe wherever you get your podcasts and join our community at nxtg.ai.